How to avoid death by 1,000 cuts. Hi, this is Josh Horn, CPA of Horn Valuation. I help business owners successfully build and sell their businesses using valuation tools that work today. If I told you I had a client that was 3 times as profitable as others in his industry, would you be interested in learning how he did it? Especially if what he was doing was easy for you to implement today. I think you want to take a look at this. I'm going to show you a quick example, particularly if you are in a transactional business. Many are. If you sell jobs or if you are in retail, this is very important to understand. I'm going to show you how he did it using a very simple technique and how you can start doing it today. Let's look at company number 1 and what they are doing. Company number 1 is selling about $1.9 million a year in products, services, whatever the case may be. And they're getting $63,000 of net income to the bottom line after taxes. So $1.9 million, $63,000 of profit. Now, what I want you to pay attention to are really a couple of things that some businesses forget to track. Maybe they don't pay attention to. And then ultimately they get to the end of the year and it's what I call the death by 1,000 cuts problem. Why do they get to the end of the year and they're not as profitable as they should be? Well, let's take a look at company number 2. What did company number 2 do to make them more profitable than 1? They did one very important thing. They paid very close attention to their gross profit margin, which is a whopping 3% higher. Now, what did my client do? What did he do that many businesses that I value don't do? He knew exactly what the profit was on every single construction job he did. Now, you may be in the construction business, you may be in the retail business. Really, the same principles apply across the board, no matter what business you're in. You have the direct cost to sell the product. You have the price you sell the product at. The difference is the gross profit that you make. And when you have jobs every single day, sometimes hundreds, sometimes thousands of them a year, if you don't get that gross profit margin right, you can blow your entire year. Now, I would not recommend you do what he did, which was put it in a paper book. Not the end of the world. You can use the computer to do a lot of these things now. The first thing you might ask is, or say was, well, they just sold more. Now, we're going to assume in this example, which is often what I see, actually what happened was very much different than that. Actually, what company number 2 did is they sold the same number of jobs, 500 jobs during the year, but they priced them $200 per job higher because they were very mindful of the gross profit margin they needed to make to hit their targets. As a result, because they only charged $200 more per job, they made $69,000 more in the year. Doing the same number of jobs, the same number of overhead, the same tax structure, everything was the same. And this is important too to understand, because in a lot of cases, in the short term, you can't change your overhead. You probably can't change your rent, your insurance, your office staff. So what do you need to understand here? First and foremost, you need to understand the profit per job. Every single job. You got to get this right. You got to get it fixed, or else you will die a death by 1,000 cuts. Pull out a few tickets. Figure out what gross profit margin you're making. Chances are you're not charging enough. This is the common problem I see. Businesses don't understand their cost structure, so they undercharge. And when they get clobbered on the gross profit margin, they can't make it up anywhere else because their overhead is fixed. What else? Understand when you might be bidding against yourself. It may really be better often to walk away from a job instead of getting killed on the gross profit margin. Many businesses live in fear. I'm not going to get another job. That phone's not going to ring again. I need to take this one, even if I need to take a haircut. Be careful with that. Because what happens is you do that every single day, every single week, every single month, all year long, and you don't make the money you should. And it's not just profit. You can't reinvest back in the business to make the business what you need to make it. Finally, build the relationship with your customer beyond transactional. This can be a difficult thing to do, but I have faith that you can do this. Price with options. Give them those extra little things during the year that other providers don't give them. Understand their needs. If they just view you as a commodity, it's going to be very easy to fall in this trap of discounting. Don't do that. Elevate your value proposition instead. And you can get out of this trap of underpricing so that you kill your gross profit margin and die a death by 1,000 cuts. This is Josh Horn, CPA of Horn Valuation. Get in touch with me if you have any questions about this. Have a great day. Bye.